Welcome to the Deep Dive. We're the show that cuts through the noise, boils down complex info, and really gets you straight to what you need to know. And look, if you've been anywhere online lately, you've definitely heard the buzz around crypto.
Oh, absolutely. It's everywhere.
Yeah, it feels like it's gone from these, niche tech corners right into the mainstream conversation. News headlines, financial reports, even just chats with friends. But let's be real, for a lot of people, the ideas behind it, the jargon, it feels less like learning a new language and maybe more like an alien one.
It's a huge barrier.
Yeah,
It really is. Stops people from really getting what it's all about.
exactly. So today, our mission in this deep dive is to try and demystify that world for you. We're going on a foundational exploration, really getting into blockchain and cryptocurrency.
So starting from the ground up.
Right. We've gone through, well, a whole stack of sources, beginner's guides, quizzes, detailed briefings, even some technical stuff. And the goal is to pull out the really important nuggets of knowledge. No hype, no unnecessary complexity. We want you to walk away with a clear, practical understanding of what this, well, what some call revolutionary technology is actually all about.
And making it make sense. That's the plan.
So what can you expect over, say, the next 20, maybe 30 minutes? We're going to unpack these ideas, which seem complex, into insights you can actually grasp.
Starting with the bedrock.
Yeah, exactly. Blockchain first. Then we'll dig into what cryptocurrency is, its core ideas, how it actually works day to day.
We'll look at the practical uses too, right?
Absolutely. Practical applications, the crucial security side of things, which is, huge in this space.
You stress that enough.
And yes, we'll even try to clear up the often confusing world of crypto taxes.
Oh, yeah, that's a big one.
So by the end, you should be genuinely well-informed, ready to understand the conversations, maybe even join in with some confidence.
Sounds good. Let's dive in.
Okay, let's descend.
That's a perfect way to put it. And look, to really get cryptocurrency, you absolutely have to start with the foundation. That's blockchain technology. It's basically the engine driving this whole digital shift.
Right. It can seem a bit abstract at first, I think.
It definitely can. But our sources actually give us a pretty good, simple analogy to help visualize it right off the bat.
Okay, let's hear it. Let's unpack this core idea. So the sources say, imagine a ledger, like a big notebook that records every transaction ever made.
Simple enough, right? A notebook.
Yeah, straightforward. But here's the twist, the part that changes everything. Now imagine this notebook isn't kept by one person or company, but copied hundreds or thousands of times across the world.
Ah, okay, that's the key difference.
That simple picture, for me anyway, it really captures the revolutionary part of blockchain. It instantly tells you this isn't like your normal bank ledger.
It absolutely does. That analogy perfectly shows the core idea. Decentralization. See, in traditional finance, you've got one entity, a bank, maybe a government, a credit card company. They control the central ledger.
Right, they're the keepers of the record.
Exactly. They're the only ones, and you have to trust their integrity, their security. But with blockchain, well, there is no single person, no company, no central authority controlling the network.
No single boss.
Nope. Instead, that control, that record-keeping job, it's spread out across many, many participants. Every computer or node in the network has a complete identical copy of that whole notebook, the ledger.
So everyone has the same information.
Precisely. And that's a fundamental shift from how we usually manage information in transactions.
Yeah.
We're moving from a single, potentially vulnerable point.
Like a bank's server room.
Yeah, exactly. To a strong, distributed web. It means there's no single point of failure, and no one entity can just go in and mess with the records.
Okay, so because everyone on the network, every node, has this identical copy of the ledger, that automatically means it's public and transparent, right?
That's a direct consequence, yes.
If the notebook is copied thousands of times, well, then everyone in the network can see every transaction that gets recorded.
It creates this inherent transparency. All the transactions are out there, visible to everyone participating.
No hidden stuff, no behind-the-scenes tweaking, which feels like a massive change from traditional systems, which are often pretty opaque,
Very opaque sometimes.
Yeah, where you just have to trust that the central authority's records are right.
But here, the beauty is you don't have to just trust. You can actually verify it yourself by looking at the ledger copy you hold or that anyone else holds.
Verification, not just trust.
Exactly. And this connects directly to another really critical feature, immutability and security. The information on a blockchain isn't just visible. It's stored in these things called blocks. And each block is cryptographically linked Think like a super secure digital seal to the block that came before it. That's what forms the chronological chain.
Hence, blockchain.
Precisely. Think of it like a unique digital fingerprint, or maybe a mathematical padlock created from all the data inside a block. That fingerprint then gets included in the next block, tying them together so they can't be separated or reordered easily.
Okay, so they're locked together.
Locked tight. And crucially, our sources emphasize this. Once a transaction is added to a block and that block gets added to the chain, it can't be changed or deleted.
Permanent?
Permanent and transparent. That permanence, plus the fact that it's distributed, meaning trying to change one copy is useless because thousands of other correct copies exist.
Which would instantly show the attempted fraud.
Exactly. That combination is key to its incredible security. It makes the data highly secure, resistant to tampering, because everyone can check its integrity constantly. It's like trying to sneakily erase a page from thousands of identical notebooks scattered worldwide, all while everyone's watching. You just can't do it without being noticed immediately.
Right, impossible. So, okay, what does this all really boil down to for us? This unique structure, decentralized, public, can't be changed. It seems like it builds trust right into the system itself.
That's the revolutionary part. You're spot on.
You don't need to trust a specific bank anymore, or a government, or some middleman.
Nope. Your trust is in the cryptography, the mathematics, and the agreement, the consensus of the whole network.
So you're trusting the tech, not institution.
Precisely. And that's why it's revolutionary. It changes the whole basis of how we establish trust in the digital world. It's a game changer for anything needing verified records, really, not just money.
Okay, that makes sense. Building on that powerful blockchain foundation, now let's bring in the thing that usually grabs the headlines: cryptocurrency.
Right. The digital money that actually runs on these blockchain networks.
So at its heart, what is cryptocurrency? Our sources make it clear, unlike, physical dollars or coins you can hold.
Yeah, you can't touch it.
Cryptocurrency doesn't exist physically. It's all digital. It operates entirely on a blockchain.
It's essentially just data entries on that distributed ledger.
Yeah.
But it's incredibly secure, verifiable, and transferable data that represents value.
So not in your physical wallet, but entries on that shared digital notebook we talked about.
Exactly. And this digital nature is directly linked to its core design idea. It's engineered to be secure, difficult to counterfeit, and crucially, independent of governments or banks.
Okay, that independence part seems really important.
It's a huge differentiator from traditional or fiat currencies. Those are issued and controlled by central authorities, subject to their policies, inflation, etc.
Like the US dollar via the Federal Reserve.
Exactly.
Yeah.
With cryptocurrency, the aim is to create a form of value transfer that isn't tied to the decisions or policies of any single institution. It offers a different kind of autonomy.
And that independence, that freedom from middlemen, that seems to be what enables these direct peer-to-peer or P2P transactions.
That's the power it unlocks.
The sources say people can send it directly to each other over the internet without middlemen.
Think about what that means practically. Faster transfers, often cheaper transfers, and you could do it anytime, anywhere.
Yeah, avoids a lot of the friction in traditional finance.
Totally. Sending money internationally often involves multiple banks, takes days, costs a lot in fees.
Been there, it's painful.
Right. With crypto, you can potentially bypass all that. Send value directly from your digital wallet to someone else's, often in minutes, regardless of borders or if banks are open.
A direct connection between two people enabled by the blockchain.
Exactly. And this brings us neatly to Bitcoin.
The original gangster, basically.
It's pretty much. Created back in 2009, right after the financial crisis, our sources highlight it as the most faked example, the absolute genesis of this digital money idea. Bitcoin showed the world that a decentralized peer-to-peer digital currency could work securely, reliably, without anyone in charge.
It kind of opened the floodgates, didn't it?
It really did. Opened up a whole new financial landscape.
But, okay, for these peer-to-peer transactions to actually happen, to get confirmed and added to that permanent public ledger, there's a missing piece, right? These miners or validators.
Ah, yes. Absolutely critical. They're the ones who make the whole thing work securely.
How do they do that? How do they make sure everything's legitimate without a central bank checking?
Great question. So our sources explain these are powerful network computers, could be thousands globally, that solve complex math problems to confirm transactions and add them to the blockchain. Now, in networks like Bitcoin's, this process is called proof of work.
Heard that term. Sounds intense.
It is. Miners use massive amounts of computing power to compete. They're racing to be the first to solve these cryptographic puzzles.
Why? What's in it for them?
Good question. It's energy intensive, but it makes the network incredibly secure because it's super hard and expensive for anyone to cheat the system or take control. The incentive for the miners, besides just securing the network, is that the first one to solve the puzzle gets to add the next block of transactions to the chain.
Okay.
And for doing that, they get rewarded with brand new cryptocurrency, newly minted Bitcoin, in this case, plus any transaction fees people included with their transfers.
Ah, so they get paid for their work.
Exactly. This competition keeps everyone honest and ensures the integrity of the network without needing a central supervisor.
Makes sense. You mentioned proof of work, but are there others? I think I've heard of proof of stake.
You have, yeah. Good point. While proof of work was the original, like Bitcoin uses, many newer blockchains use different methods. Proof of stake is a big one. It achieves that network agreement, that consensus, in a different way, often using much less energy. Instead of raw computing power, validators are typically chosen to propose and confirm blocks based on the amount of crypto they stake or lock up as collateral.
So different mechanism, same goal, secure the network.
Precisely. Different paths to the same destination of decentralized consensus.
Okay. And once the transaction is checked, verified by these miners or validators, and added to a block, it's set in stone, basically.
That's the immutability we talked about. The sources are crystal clear. Once added, these transactions are permanent and cannot be changed or deleted.
Wow. Okay.
This whole process, driven by the collective effort of the network's participants, is exactly what builds the trust and ensures the integrity of the digital currency. You don't need a bank acting as a guarantor.
The network itself provides the trust through this intense decentralized checking process.
You got it.
All right, so we've got the what's blockchain, crypto, and the how miners transactions. Let's get into the why. Why does this stuff matter beyond just being, cool new tech? What are the real benefits, the bigger picture implications?
Yeah, the so what question. It matters a lot, actually, primarily because blockchain and crypto offer levels of transparency and security that traditional systems often lack.
Okay, unpack that. How so?
Well, think about things like data breaches we hear about constantly, or financial scandals, or just how opaque some big financial institutions can be.
Right, you don't always know what's happening behind the scenes.
Exactly. But blockchain's design, where every transaction is visible on a public, auditable ledger, all linked cryptographically, creates an environment with, frankly, unprecedented security and auditability. This inherently makes fraud much harder, increases accountability, and builds that new kind of trust we discussed, trust in the system itself, not just an institution.
Can you give an example outside of just money?
Sure. Think about supply chains. Tracking goods from source to shelf. Every step, manufacturing, shipping, customs, delivery, could be recorded on a blockchain.
Creating an unchangeable history for that product.
Exactly. Guarantees authenticity, proves origin, fights counterfeiting. Huge implications for things like food safety, luxury goods, pharmaceuticals.
Wow. Okay. That's powerful. And beyond the security and transparency, what about just practical stuff like speed and cost?
That's another huge advantage.
Yeah.
The efficiency aspect is really compelling, especially if you've ever been frustrated by traditional financial delays or fees.
Which is probably most people listening.
Probably. Our sources highlight that crypto can be sent anywhere, anytime, fast, and often with low fees. Think about those international wire transfers again. Days to clear, multiple banks involved, hefty fees taken out at each step.
Yeah, you send $100, they might only get $85 after all the charges.
Right. With crypto, you can potentially send value across borders in minutes, sometimes seconds, often for a fraction of the cost. That's a massive efficiency gain for global business and personal payments, like sending money home to family.
Okay, that leads really nicely into something else the sources mentioned, which sounded profound. Financial freedom and inclusion.
Ah, yes. This is where, as the sources say, it gets really interesting.
It sounds like a big claim. It opens the door to new financial tools and freedoms, especially for people without access to traditional banking.
Let's really pause on that, because this is potentially game-changing on a societal level. In huge parts of the world, billions of people are unbanked or underbanked.
Meaning they just don't have bank accounts?
It's more than that. It means they often lack access to basic essential financial services, secure ways to save money, affordable credit, insurance, even just reliable ways to send or receive money, maybe from relatives working abroad.
Why? What stops them from using traditional banks?
Often is practical barriers. Banks might require stable physical addresses, extensive ID documents that maybe they don't have. minimum account balances they can't afford.
Or maybe there just isn't a bank branch anywhere near them.
Exactly. It creates this cycle of financial exclusion.
Okay, so how does crypto potentially change that?
Well, think about what you need for crypto. Primarily, an internet connection which is increasingly available via smartphones globally, and a digital wallet, which is often just free software.
Much lower barrier to entry.
Much lower.
Yeah.
This technology can foster greater financial inclusion by giving people direct access to a digital financial system without needing permission from traditional institutions that might exclude them. It empowers people to participate in the global economy more directly, gives them more control over their own assets and how they transact.
So like that example of a worker sending money home.
Yeah, imagine them sending remittances home without losing a huge chunk to fees and intermediaries. Or a small farmer in a remote area being able to receive instant digital payment for their crops, maybe from an international buyer.
Instead of waiting weeks for a check or dealing with local moneylenders.
Exactly. This isn't just tech for tech's sake. It holds real transformative potential for economic empowerment, for potentially millions, even billions, worldwide.
That really puts it in perspective. It's a powerful vision. But okay, let's bring it back down to earth for someone listening who's thinking, all right, this sounds interesting, maybe even important, but where do I even start? It still feels a bit daunting.
Totally understandable. It's a new landscape.
So let's talk practical steps. What do you need to know? And crucially, how do you stay safe? Security seems paramount here.
Absolutely paramount. Let's start with some essential vocabulary. You need these terms to even navigate the space.
Okay, hit me.
First, and maybe most fundamental, wallet.
Hmm.
A crypto wallet. The sources define it as a software or hardware tool that stores your crypto private keys.
Okay, private keys, we'll get to those. But the wallet itself, it holds the crypto.
Not quite, and that's a common misconception. Your crypto actually lives on the blockchain itself, on that distributed ledger. The wallet holds the keys, the secret codes that prove you own and control your crypto on that ledger.
Ah, okay. So it's like my digital keyring, not the vault itself.
Perfect analogy. It gives you access to your assets on the blockchain. Wallets can be software on your phone or computer, often called hot wallets because they're connected to the internet.
Okay.
Or they can be physical hardware devices, like a special USB stick. Those are often called cold wallets because they're kept offline for extra security.
Hot wallets, cold wallets. Got it. Now keys. You mentioned private keys.
Yes, and there are two types, and knowing the difference is absolutely critical for your security. First, the private key. The sources are extremely direct here. Your secret code to access your crypto, never share this.
Sounds serious.
It cannot be overstated. If you lose your private key, you lose access to your crypto forever. If someone else gets it, they can access your crypto.
No password reset, no calling customer support.
None. Zero. It is solely your responsibility. Think of it like the one and only key to a physical vault filled with cash, but it's digital.
Okay. Intense. What's the other key?
That's your public key, which is often represented as your wallet address. This one is like your email address, the sources say. Others can send crypto to it. It's public and safe to share.
Ah, okay. So public key address is for receiving, private key is for sending or accessing.
Exactly. You share your public address so people can pay you. You guard your private key with your life because it controls your funds. That distinction is vital.
Got it. Public share, private hide, next term.
Exchange. This is simply a platform where you buy, sell, or trade crypto.
Like a stock market, but for crypto. Or a currency exchange booth.
Both good analogies. It's your main gateway. It's where you usually swap your traditional money like US dollars or euros for crypto, and importantly, where you can swap it back again later.
The on-ramp and off-ramp.
Precisely. And one more for now, token.
Okay, I hear coin and token. What's the difference?
It's a subtle but important distinction. A token is defined as a unit of value on the blockchain, but it's broader than just money. While Bitcoin is a cryptocurrency, a native coin of its own blockchain, a token often represents something else built on top of a blockchain. It can be currency, a stake, or a digital asset.
So not just digital money.
Right. A token could represent, say, a share in a decentralized project, like owning stock. Or it could give you voting rights on how a network develops. Or it could even be a unique digital collectible thing, digital art, a concert ticket verified on the blockchain.
So token is a broader category for various digital assets on a blockchain.
Exactly. They have different functions beyond just being a medium of exchange like Bitcoin aims to be.
Okay, vocabulary down. Now, how do you actually start choosing that first exchange? Seems like a big first step. What should beginners look for?
It's a critical decision. Several factors are key. First, definitely ease of use. Especially when you're starting, you want an interface that's intuitive, not one that throws a million confusing charts and options at you immediately.
Less intimidating is better.
For sure. Our sources mention platforms like Coinbase and Gemini specifically for offering simple designs for beginners. That helps ease you in.
Makes sense. What else? Security must be huge here.
Absolutely paramount, non-negotiable. You must check for two-factor authentication, or 2FA. That adds a vital extra security layer beyond just your password, like getting a code on your phone.
Essential.
Essential. Beyond that, do some research. Look into the exchange's history of security. Have they suffered major hacks? How do they handle it? Do they talk about security practices like keeping most funds in cold storage offline? Do they offer any insurance?
Good points. What about handling my actual money?
Right. Currency support.
Yeah.
Make sure the exchange works with your local currency like USD, EUR, GBP, whatever it is, and check the available payment methods. Can you easily link your bank account? Use a debit card? Are the fees reasonable for those methods?
Also, look for signs they follow regulations, right? Like asking for ID.
Yes, definitely. Things like KYC, Know Your Customer, and AML, anti-money laundering procedures. While sometimes a bit annoying during sign-up, it's actually a good sign. It means the exchange is trying to comply with regulations and operate legitimately.
And overall reputation matters, I assume?
Hugely. This is not the place to chase obscure platforms promising the moon just because they popped up yesterday.
Stick with the known players.
Generally, yes, especially at first. The sources recommend starting with established exchanges like Coinbase, Kraken, or Binance US. Specifically mentioning the U.S. version for compliance reasons there. These have built reputations, navigated regulatory hurdles, and usually have better security and customer support.
And the advice is to actively avoid.
Explicitly avoid platforms with poor reviews or limited history. If something looks sketchy or too good to be true, it probably is. Prioritize the safety of your funds above all else.
Sound advice. Okay, so you've picked your exchange, signed up, maybe bought your first bit of crypto. Now, the nerve-wracking part. Sending or receiving it. You mentioned earlier this is irreversible. That feels like a really big deal.
It is a massive deal, and where meticulous care is not just recommended, it's absolutely essential. You are your own bank here.
So walk me through sending crypto safely.
Okay, step one,
Mm-hmm.
find your wallet address. This is that destination address. We talked about that long string of characters. Alphanumeric, unique to the recipient and the specific crypto and network. That's your crypto destination.
Copy and paste carefully, I assume.
Very carefully.
Yeah.
But here's the absolute golden rule, emphasized strongly in our sources. Always verify with a small transaction first.
Send a tiny amount before the real amount.
Exactly, because remember, crypto transfers cannot be reversed. If you mistype even one character in that long address, or if you send it on the wrong network, those funds are lost forever.
Oh, wow. Gone. No takebacks.
Gone. Sending a tiny test amount like $1's worth is your safety check. Confirm the recipient got that small amount before you send the larger sum. It's a small price to pay for peace of mind and avoiding potential disaster.
That's such a crucial habit to build. It's so different from banking where you might be able to recall a mistaken transfer.
Totally different mindset required. You have full control, but also full responsibility.
Okay, what else is critical when sending?
The other absolute must is to select the correct network. This trips up so many people.
What do you mean by network?
Many cryptocurrencies can exist on multiple blockchains or networks. For example, the stablecoin USDC exists natively on Ethereum as an ERC20 token, but also on other chains like Solana, Polygon, Avalanche, etc. You must ensure that the network you select when sending matches the network the recipient is expecting to receive on.
So if they give you an Ethereum address, you have to send via the Ethereum network.
Precisely. If you try to send an Ethereum network token to, say, a Solana network address, or vice versa, the source warns, otherwise your funds may be lost. It's like putting mail in the wrong country's postal system. It just won't arrive. Always confirm the network matches.
Okay, address checked, test sent, network confirmed. Anything else?
Just be prepared to wait for confirmations. Transactions aren't usually instant like a tap to pay. Blockchain transactions need verification by those miners or validators. This takes time, seconds to minutes, depending on the specific crypto and how busy the network is. Don't panic if it doesn't show up immediately.
Patience is a virtue.
In crypto, definitely. And just to hammer it home one last time, the sources say, underline, bold, flashing lights. Double-check addresses before sending. One wrong character means lost funds forever.
Message received. Extreme caution required.
It sounds stark, but it's the reality. Diligence is your best protection.
Okay. Now, let's flip it. Cashing out, you've held some crypto, maybe it's gone up, maybe you just need the money back in your regular bank account. How does that work?
Right. Bridging back to the traditional financial world, it's usually a pretty straightforward process, broken down into a few steps by our sources.
Let's hear them.
Step 1. Transfer to exchange. If your crypto is sitting in your personal wallet, hot or cold, you generally need to send it back to a centralized exchange that allows you to sell it for fiat currency like the one you bought it on.
Okay, send it back to Coinbase, Kraken, etc.
Exactly. Step 2. Sell for USD, or your local currency. Once the crypto arrives in your exchange account, you use their sell function. You trade your crypto for dollars, euros, pounds, whatever. It's usually simple, like placing a sell order on a stock platform.
So now you have cash balance on the exchange.
Correct. Step 3. Withdraw at a bank. Now, you initiate a withdrawal of that fiat currency balance from the exchange to your linked bank account. The most common method mentioned, especially in the US, is an ACH transfer. These are usually free, but take 1-3 business days to land in your account.
Standard bank transfer time, basically.
Pretty much. The sources also mention that sometimes card withdrawals are faster, but cost more. So you might have an option to withdraw to a linked debit card almost instantly, but there will likely be a higher fee.
So a trade-off between speed and cost there.
Typically, yes. And the final step, step 4, verify completion. Just keep an eye on your bank account and confirm the funds have arrived, remembering that 1-3-day window for ACH.
And that's it. Crypto back to cash in the bank.
That's the basic process. For larger withdrawals, just be aware the exchange might ask for additional verification steps as part of those KYCML regulations we mentioned earlier. They have reporting requirements too.
Makes sense. Seems manageable if you follow the steps. All right, now for a topic that, well, it often catches people completely by surprise. It's a huge aha moment, and not always a pleasant one if you didn't know. Taxes.
Oh boy.
Yes.
This is absolutely critical to understand from day one. Ignoring taxes with crypto can lead to serious problems down the line.
So the big thing is how the IRS, in the US at least, views crypto. It's not what many people assume, right?
Not at all.
Yeah.
And this distinction is the foundation for everything tax-related. The sources are extremely clear. The IRS classifies cryptocurrency as property, not currency, for tax purposes.
Property, like owning stock, or real estate, or art.
Exactly like that.
Yeah.
Not like owning foreign currency. This isn't just legal wording. It has direct practical consequences for how you're taxed.
So for you, the listener, what does being classified as property actually mean when you interact with crypto?
It means, and this is the key takeaway, all trades, swaps, and sales of cryptocurrency are considered taxable events.
Wait, all trades and swaps, not just when you sell back to dollars?
Correct. That's the part that trips up so many beginners. It's not just the final cash out that matters for taxes.
Yeah.
The sources explicitly state even swapping one cryptocurrency for another is taxable.
Can you give an example?
Sure. Let's say you bought one Bitcoin when it cost $30,000. Later, that Bitcoin is worth $40,000. You decide you want some Ethereum instead, so you trade your Bitcoin directly for, say, 10 Ethereum.
Okay, no dollars involved in that swap.
Right. But because your Bitcoin appreciated by $10,000, 40K value, 30K cost, that $10,000 gain is considered a capital gain at the moment you trade it for Ethereum. It's a taxable event right then and there.
Wow, okay. That's huge. So you have a tax obligation even though you never touched traditional money.
Precisely. Similarly, if you use crypto to buy something, a coffee, a laptop, whatever, that's treated as selling the crypto for its dollar value at that moment, which is also a taxable event.
So buying a $5 coffee with crypto that you originally bought for $2 means you have a $3 capital gain to report.
In principle, yes. Also, receiving crypto as payment for work is generally taxed as income based on its value when you receive it. And earning rewards from things like staking or mining is also usually taxable income.
Man, okay. That sounds like a lot to track if almost every interaction is potentially taxable.
It absolutely can be a bookkeeping nightmare if you're not organized from the start.
So how do you manage it? How do you stay compliant?
Meticulous record keeping is your absolute best friend. You need to track every transaction, every buy, every sell, every trade, every swap, any income received in crypto. You need dates, amounts, values in dollars at the time of the transaction, what you exchanged it for.
For someone trading frequently, that sounds nearly impossible to do manually.
For active traders, it basically is, which is why the sources strongly recommend using specialized crypto tax software.
Okay, like what?
They specifically name popular tools like CoinTracker, Coinly, or ZenLedger. There are others too. The great thing about these platforms is they can automatically track your profits and losses by connecting securely to your exchanges using APIs.
Ah, so they pull in your transaction data automatically.
Yes, they connect to your exchange accounts, pull the history, calculate your gains and losses according to IRS rules like FIFO or LIFO accounting, and can generate the tax forms you need, like Form 8949.
That sounds like a lifesaver.
It significantly simplifies what would otherwise be an incredibly complex and error-prone manual process. It's well worth the subscription cost for most people, even moderately active in crypto.
Good tip. Anything else on managing taxes?
Just the basic advice.
Yeah.
Keep records. Even if you use software, save your own copies of transaction histories, download statements from exchanges, maybe even take screenshots, have backups.
Because the burden of proof is on you.
Ultimately, yes. You need to be able to substantiate the numbers on your tax return if asked. Treat your crypto record keeping with the same seriousness you would for stocks or any other investment.
Okay, taxes. Definitely something not to ignore. Got it. Whew. Okay, we have covered a ton of ground today. Seriously deep dive. From the absolute basics of blockchain, what crypto is, how it works,
The benefits, the potential, the practical steps for getting involved safely.
sending, receiving, cashing out, and those oh so important taxes.
Yeah, quite the journey.
Let's try and bring it all together now. Let's synthesize this. Based on all the sources we've pulled from, what's the overall vibe? What's the collective stance on cryptocurrency that emerges?
That's a great way to look at it. Analyzing all the material together, a really consistent tone comes through. It's overwhelmingly neutral and instructional, educational.
Focused on explaining, not persuading.
Exactly. The main goal is clearly to demystify these complex ideas, make blockchain and crypto accessible, understandable for someone starting out. However, underneath that factual, here's how it works presentation, you definitely sense an underlying conviction about the potential and the significance of the underlying technology, the blockchain itself.
So, kind of bullish on the tech, but cautious about how people interact with it.
That sums it up pretty well, I think. The guides seem implicitly positive, even bullish, on the transformative power of the technology long term. But they are simultaneously very cautious, very practical when it comes to user engagement. Heavy emphasis on security, risk management, doing your homework.
Understand the power, but proceed with caution.
Precisely. They want you to understand, but also to go in with your eyes wide open to the risks and responsibilities.
Okay, let's break that down for specific areas the outline mentioned. How is Bitcoin presented in these sources?
Bitcoin comes across very factually. It's consistently positioned as the most famous example, the OG, the inaugural cryptocurrency. The sources stress its historical importance, its pioneering role in proving the concept of decentralized digital money.
But no hype about its price.
No, not at all. They maintain a strictly neutral stance on its value or future price. The focus is always on its function within the ecosystem, its role as the first working example. It's presented as historically significant, technically foundational, but without speculative commentary.
Okay, what about all the other cryptos? The altcoins?
The sources don't really dive into specific altcoins by name, but they address the broader landscape through that definition of tokens we discussed earlier.
Right, the idea that tokens can be more than just currency.
Exactly. By defining tokens broadly representing a stake in a project or another type of digital asset, they acknowledge the diversity out there. And the fact that they explicitly mention swapping one cryptocurrency for another as a taxable event clearly shows they recognize the existence and trading of many different digital assets beyond Bitcoin.
So the stance is descriptive, acknowledging the variety.
Yeah, descriptive and inclusive of that wider crypto world, showing it's not just Bitcoin, without endorsing any specific altcoin project. It's about understanding the categories of assets that exist.
What about regulation? We hit taxes hard, but anything broader?
Regulation is viewed almost entirely through that practical lens of the IRS classification crypto as property. That's the immediate, concrete regulatory reality users face.
So focused on compliance with current rules.
Exactly. The tone is strictly factual, directive. Here's what the current rules mean for you and your tax obligations. There's no real opinion expressed on whether regulation is good or bad, needed or not, or what future regulation might look like. It's just, here's the current state of play you need to deal with.
But there did seem to be a really strong positive feeling about decentralization itself. That felt like a core message.
Oh, absolutely. Decentralization is consistently highlighted as a fundamental principle, a key advantage of blockchain. The sources really emphasize how it allows for systems where no single person, company, or central authority controls the network.
Leading to better security, transparency.
Right, and censorship resistance.
Yeah.
The language used words like revolutionary, phrases like no single entity controls, definitely conveys a strong positive conviction in the value of decentralization as a major technological and potentially societal breakthrough. It's presented as the core innovation enabling trust in these new systems.
And that idea seems to flow directly into the theme of financial freedom.
It really does. Financial freedom and inclusion are presented as major potential benefits stemming directly from this decentralized technology. Remember that quote? It opens the door to new financial tools and freedoms, especially for people without access to traditional banking.
Yeah, that was powerful.
The framing around that definitely has a sense of optimism, a conviction about the technology's potential for positive societal impact, for bringing more people into the financial system globally. It's presented as one of the most compelling why it matters arguments.
Okay. Did the sources venture any guesses about the future? Market predictions? Where crypto prices are headed?
Nope. Very deliberately, it seems, they avoid any specific market predictions or price forecasts. Zero speculation.
So what do they say about the future?
Their focus shifts entirely to the user's ongoing learning journey. They explicitly mention that future learning will focus on real-world ways to use crypto every day.
Practical applications.
Right. And crucially, and how to think like a smart investor, not a hype follower.
Ah, that's interesting.
It really is. It shows a forward-looking stance that sees crypto as an evolving field with practical uses, but emphasizes informed, rational participation over getting swept up in speculative bubbles or social media hype. It's about empowering the user with knowledge for the long haul, not giving them hot tips.
Okay, that paints a clear picture of the source's perspective. So if we had to boil down everything we've extracted from these guides today, what are the main overarching messages, the key themes that kept coming up?
I think we can identify a few really strong, consistent themes. First, and maybe foremost, is empowerment through understanding. The whole point seems to be, let's demystify this, let's make it accessible so you can understand it and make informed decisions. Knowledge is power, basically.
Okay, makes sense. What else?
Second, a massive emphasis on user responsibility. In this decentralized world, you are your own bank. That means security, protecting those private keys, and meticulous record keeping for taxes are your job. There's no safety net, no intermediary to bail you out. It's on you.
The flip side, control is responsibility.
Exactly. Third, the idea of trust through technology. The core principles, transparency, decentralization, immutability, are presented as the foundation for building trust in a new way, relying on math and code rather than just institutions. Fourth, that significant theme of financial innovation and inclusion. The potential for crypto to create new financial tools and, really importantly, broaden access to financial services for people globally, especially the unbanked, is a recurring positive note.
The societal impact angle.
Right. And finally, maybe less exciting, but absolutely essential. Compliance is key, especially regarding taxes. It's presented as a non-negotiable part of participating in the crypto economy responsibly. You have to follow the rules.
Those 5 themes really capture the essence of what we've discussed: empowerment, responsibility, trust via tech, inclusion, and compliance. Did you notice any points where the sources disagreed with each other or presented conflicting information?
Honestly, no. The material was remarkably consistent. All the sources, the guides, the briefings, the explainers presented the information cohesively. There were no internal contradictions or areas of disagreement within the provided material itself. It felt like a unified curriculum designed to give a clear, foundational understanding from a single perspective.
Okay, so a consistent message throughout. All right, final question on the synthesis. Thinking about everything, all the definitions, the warnings, the potential, what stands out to you as the single most insightful or unique comment? Something that really crystallizes the core message for you, the learner.
That's a tough one. There's a lot of good stuff. But for me, the comment that really encapsulates the practical, long-term approach these sources advocate for, the one that cuts through potential noise, is that line about future learning. How to think like a smart investor, not a hype follower.
Why that one?
Because it so powerfully distills the entire philosophy. It's not about getting rich quick. It's not about chasing the latest meme coin. It's about equipping yourself with knowledge, understanding the fundamentals, managing risk, and engaging with this technology in an informed, responsible, sustainable way. It steers you away from speculation and towards rational participation. In a field often driven by hype, that focus on becoming a smart investor mindset, not just a follower, feels incredibly valuable and grounding.
That's a great point. Thinking, not just following. A really powerful takeaway. And look, you've just heard how this technology, blockchain, creates this entirely new way of establishing trust without needing those traditional middlemen. How it potentially opens doors to new financial tools, new freedoms, maybe for millions who were previously excluded. We've unpacked those core ideas, decentralization, immutability. We've walked through practical steps for how you can engage safely, from choosing an exchange to sending crypto carefully. And we've tackled those crucial tax rules you absolutely need to know.
Hopefully you're feeling equipped now with that fundamental knowledge.
Yeah, ready to navigate this exciting and, yes, still evolving digital space with more confidence. So as you reflect on all this, here's a final thought to leave you with. We've seen how a system built on math, on cryptography, on distributed agreement can fundamentally change how we manage and verify value, how we do finance. But think beyond just money. What other areas of our lives? Maybe healthcare record privacy, maybe verifying votes in elections, tracking goods and supply chains, proving ownership of digital art or music. What other areas might be truly transformed if we could build trust directly into the fabric of our digital interactions?
When you start thinking about trust as a programmable layer, the possibilities get pretty profound.
They really do. Far beyond just digital cash. We hope this deep dive has given you that solid foundation and maybe sparked your curiosity to keep learning. Until next time, keep diving deep.